Welcome to the September trade floor update. Well, there's a lot of talk about tapering at the moment, and what I'm referring to is central bank tapering, their removal or attempted removal of their quantitative easing programs. We've just had the RBA roll out their own form of tapering, and there's likely to be more of that over the next few months. And what we're observing is that there's a lot of question marks about the implications for markets. Rob, with many assets already finely priced, there's a lot of focus on this tapering path. And there's a lot of question marks about what should be done to portfolios. Should there be risk taken off the table, more defensive put into place? When you're thinking about investing, can you share with us a little bit more about those areas that our clients should be thinking about?
Yeah, absolutely, John. I think the most important takeaway is that the path to tapering has been temporarily at least delayed. Obviously, with the spread of the Delta variant, potential growth rates are not being reached in terms of what would have been expected, say, 3 to 6 months ago. I think the most important thing, though, is that even though we will start to move into some form of taper phase, and I'll give you a little bit of detail on that, we still come from the backdrop that very stimulatory policy will remain and rates will remain on hold for a while. In terms of the Fed, there's some scope for the advance notice of tapering to come about in sort of the November period, and any tapering would actually occur thereafter. And then from the RBA, as you mentioned, they have announced already to move from $5 billion per month to $4 billion. They reiterated that recently, and what they have done is extended that $4 billion period when they'd already confirmed that it would continue until November. Now that's been confirmed to continue until February 2022, giving the markets a little bit more certainty around a very gradual pace of tapering.
So with valuations across many asset classes already, it's fair to say, quite rich, what should investors be thinking about in relation to their own portfolio? Should they be thinking about fine tuning? As you look at your own portfolios day to day, what's on your mind?
Yeah, I guess we're still in the same phase that many assets are fair at best, rich at worst. And so when we still think about risk premium, some assets jump out as being closer to fair than others. And obviously anything that has some illiquidity associated with it, private equity, private debt would be one of those assets that does look relatively well priced. I think the most important takeaways, though, in terms of constructing bond portfolios is to be cognizant that now's not the time to have very significant positions away from your policy benchmarks or your long-term asset allocation targets. We do know that there is a fair bit of noise out there in terms of the outlook for inflation, for the growth rates, obviously for some of the tapering issues we mentioned before. So when it comes to portfolios, we always try to keep it simple. We want to target the most high carry and attractive part of yield curves around the 5 to 7 year. As we mentioned in previous updates, we still prefer the COVID impacted sectors of the credit market. We still think there's upside, especially when the light at the end of the tunnel in terms of vaccinations is very close. We still even prefer some of the universities that fall into that bucket in the Australian context. And finally, on the semi-government space, the semi-governments have had to issue by their state treasuries more bonds than they otherwise would have if we weren't in this lockdown phase. So those spreads have been widening, and we're starting to use that as an opportunity to move from neutral or even underweight positions into small overweights.
Well, thanks, Rob. And for all of you, if you'd like to learn more about anything we've discussed today, please visit pimco.com.au or get in touch with your PIMCO account manager. Bye for now.